Welcome to the latest edition of International Tax News. I'm Doug McHoney, PwC's International Tax Services Global Leader. In this edition, we cover selected tax updates from around the world, including my favorite topic, Pillar 2. If you would like to go in-depth on similar topics, check out the Cross-Border Tax Talks podcast, in video on YouTube or in audio wherever you find your podcast. Now turning to our current edition. First, the Kuwaiti Ministry of Finance published executive regulations for the domestic minimum top-up tax on June 30th. The executive regulations supplement the DMTT law, which is effective from January 1st, 2025. As anticipated, the executive regulations are largely in line with the Globe Model rules. The regulations incorporate the current elements of the OECD commentary and administrative guidance, and also provide mechanisms to update areas where further administrative guidance may be issued. Next, the Vietnam National Assembly ratified a new law on corporate income tax, which takes effect on October 1st, 2025. Under the new law, the standard corporate income tax rate will remain at 20%. However, new tiered rates are introduced for smaller enterprises. For enterprises with annual revenue up to 3 billion Vietnamese dong, the rate is now 15%. And for enterprises with revenue between 3 billion and 50 billion Vietnamese dong, the rate is 17%. Importantly, these reduced rates do not apply to small and medium-sized enterprises or SMEs affiliated with larger enterprises that do not themselves qualify as SMEs. Finally, the Belgian Constitutional Court issued a decision on July 17th regarding the constitutionality of the undertax profit rule as part of Belgium's transposition of the EU's Global Minimum Tax Directive. The court did not rule on the merits of the constitutional challenge, but instead referred the question of the validity of the UTPR provisions under the directive to the Court of Justice of the European Union. This referral to the CJEU means that we may not have a final decision for 12 to 24 months. The case could, however, be decided prior to the date when the first UTPR filings are due. Thank you for reading PwC's International Tax News. I look forward to speaking with you again on the next edition and on the next episode of the Cross-Border Tax Talks podcast.